Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for stopping by to listen to another episode of Zen and the Art of Real Estate Investing. We're up to episode 121 and cruising along, but we're not stopping trying to get the best guests. So this is just another one of them. But before we get to that, I just want to remind you that it's really important to anyone who has a podcast that you subscribe if you like listening. You'll get the episodes automatically. It helps us move forward on all of those charts and things that help podcasters do better. So if you make sure that you're subscribed, I would really appreciate it wherever you listen to podcasts. This week, we have Frank Rohde. He created a company called Ownify. We're going to talk all about creating a new path to home ownership. So heads up, this applies to first-time homebuyers as well, but it's done by partnering with investors. This is really interesting. Give this show a listen. I think you're going to like it. Let's go. This is episode 121 of Zen and the Art of Real Estate Investing with my guest, Frank Rohde. Frank is the CEO and founder of Ownify, Home Ownership Reimagined. Ownify partners first-time homebuyers with socially conscious investors. Together, they're creating a new path to ownership. This is really interesting. Frank's also been investing. His co-founder has been investing for years. So we're going all parts of real estate today. Frank, welcome to the show.
Thank you, Jonathan, for having me. Excited to be here.
Yeah, I'm excited to talk to you. And I was telling you before, I'm like a big tech person. I really like where real estate and tech intersect. So it'll be exciting to go through this conversation. But I know you have a business background. You've been in the mortgage industry. When was the first time you wanted to start a company that was specific to real estate?
Really, the specific to real estate was Ownify, this company, about 2 years ago. I've dabbled in real estate as an owner, as an investor, as a landlord, but it was always kind of tangential to my main career, right? So I think in the parlance of real estate investors, I was always a W-2 guy, right? But always focused on startups and an early stage. So as an entrepreneur, trying to build wealth and success that way, but outside of real estate. And so Ownify is really the first deep dive into real estate between me and my co-founder.
Yeah, I actually see that as a correlation to a lot of investors that I talk to, because a lot of investors who get started are still working a regular W-2, and they kind of know about real estate as an investment entity, but they don't even know that that could be their thing. Maybe they own a home and don't even consider themselves an investor. So that even investment to that investor, it's tangential in the beginning until it goes off. Why did you decide? Was Ownify an idea, or were you thinking, I want to do something in the real estate space specifically?
Ownify really came out of kind of two founding reasons and two different directions. One was my personal experience when I bought my first home. This is now 20 years ago in San Francisco, a condo. And, at the time I had a good job, was making decent salary, but didn't have the savings for the down payment, right? And this was $824,000 condo. In 2003, mind you.
That's very light in San Francisco, which we'll talk about.
Yes. And at the time, my parents helped me with the down payment, which was very nice. And, obviously very grateful for them. And I ended up purchasing the condo and lived in it for a number of years, eventually rented it out. And, so that was all good. But at the time, I remember thinking, how come I have to borrow money for the down payment or have to have my parents help me? Shouldn't there be a better path here? And that kind of stuck in the back of my head. And subsequently, I started an online insurance company with a couple of co-founders. I ran a company called Nomis Solutions more recently, which was a software company. And as part of that journey, running Nomis, we built the pricing engine for a lot of the large mortgage lenders. So I got very deep into the bowels of mortgage math, right? How does how does the mortgage work? How does, the benefit for the consumer work? How does the benefit for the investor work? When does it work well? When does it not work so well? And, working with a lot of the big mortgage lenders, we were ingesting their data. And what I saw more and more was that the first-time buyer was getting squeezed out for a number of reasons. And we can dive into exactly what's driving that problem in the market.
Yeah.
But saw that more and more in the data and eventually decided it's a big need. It's a big problem, right? It's a societal problem, quite frankly, and someone should do something about it. And at the same time, whenever there's a problem, we kind of look at it and go, there's an opportunity here. If you can provide a better solution out there, then you can create real value for investors and real value for consumers, customers, and investors, not just into the company, but into real estate as well. So I sold the software company and started Ownify about 2 years ago, and have been working on this new structure as a new path to home ownership for first-time buyers in particular ever since.
Yeah, great. We'll definitely get to that. I'd like to start with your journey, though, because it seems like it took all that time for the ideas to come together with parts. But I was thinking when you were saying it, it seems easy. Okay, we borrow money from our parents. A lot of us did that. But it also feels like you're giving your parents, you're trying to become an adult, and then you're giving your parents some type of like minor ownership, even if they're not going to take it. And that becomes maybe a little bit uncomfortable. And of course, everybody doesn't have parents who can give them money. And this was part of the beginning of the journey, right, for you?
That's exactly right. Yeah, I mean, and a lot of us are blessed in that, we have parents who have the assets to help. And that's great if you have it. But if you think about it, what if you don't have parents, who have the assets and the means to support you? Or what if you don't feel comfortable asking them? Or
I was thinking of the parent that gives you the money to invest, but then feels like they need to dictate what you do, which really defeats the whole purpose of like first time home ownership. Like it's such a major thing. You really don't want, it's like we always joke in the on market world, when you get to a home inspection and then the dad gets out of the car, you're like, well, this one's going to fail. You don't want them navigating your journey. So I it's interesting from all ends, but certainly financially, there's somebody else that it's easier to be beholden to that doesn't have that kind of same emotional connection to you or the property.
Yeah, I mean, it's a step that you take, right, as a first-time buyer into independence. And if your parents are coming along, that can be great, but it can also put constraints on you, right? And then there's the other issue, quite frankly, if your parents help you with the down payment and it's a roundabout loan, it's not a gift, right? Yeah. You're technically breaking lending guidelines, right? And you'd have to declare that to the lender, and the lenders don't like it when it's a loan, right? And so it's a gray area. It's not great.
Yeah. So in regard to your journey, though, I also want to hit on one thing about Ownify before we get into the full scale. So when we talk first-time home buyer now, what I've seen a lot is there's a lot of newer investors who are choosing to keep renting and then buy an investment property first. Is this something that can be an option for that too? I know we'll get into it more, but I'm seeing the differential where, sometimes people are choosing to rent because it makes more sense, but then they have options to invest, as a first-time buyer would become an investment property.
Yeah. So we definitely encourage folks who are renters to invest in Ownify, in buying either shares in homes directly or investing in the fund we've started, obviously subject to SEC accreditation guidelines and all that. Yeah. But the core value proposition to the first-time buyer is really designed around an owner-occupant, someone who lives in the home, rather than using Ownify to finance an investment property, right? That's not the intent, and that's not what we're currently set up to do.
Yeah. And again, we'll get to it, but it's investors that are funding it. So that's how they get together. And that's where we'll connect the investors. Just in regard to your journey, though, I think a lot of this probably relates to affordability too. And with you buying your first place in an area like San Francisco, which has taken a very long turn to where it is now. What is it meant to be operating as a homeowner and an investor who's been in that market in your journey through all these companies and just with real estate in general? Because now you look at San Francisco, it doesn't look like it did, 20 years ago, but there's opportunity everywhere in some fashion.
Well, I think for me, it just highlighted, one, how important real estate is to wealth creation, right? I think for everyone, not just in San Francisco, but in particular in cities where home prices have continued to appreciate, disproportionately, right? And if you can get into the property market early on it's a great driver of wealth accumulation. And the flip side of that is also how hard it is to get into the market, right? And you see this here probably in San Francisco, but in most coastal cities, right? In a number of cities in general, you see it being harder and harder, right? And I see it with friends here, and I see it with friends and colleagues in markets where we started, and other markets where the average age of the first-time buyer just keeps going up and up and up, right? Because it is getting harder. So living in San Francisco as a part of my personal journey just kind of highlighted that, right? Every time you see property prices and you hear, so-and-so bought a house for how much? Well, it's crazy.
Yeah. And I think those markets make it more, I guess, not accessible to buy there, but the options for investing become more of an idea, because a lot of people will say, like, I just can't buy anything in my market. To think at that time you had to pay $825,000 for a condo. Now these, I would just look in San Francisco and you see like kind of dilapidated Victorians for $2.5 million, and you're like, someone in the middle America is like, that's ridiculous. Why would you buy that? Because it could be worth $5 million.
Do you buy it for 2.5 to fix it up and sell it for 5, right?
Right. I mean, and that's part of the game of real estate. And I think that the thing that I think a lot of people forget that definitely applies to what you're doing at Ownify is that I've always said that first-time home buyer just doesn't think they're an investor, but they are investing. They're making their biggest investment that they've ever made, for sure, into a residence that they can also enjoy. So finding these alternative access points for people to get in there, I think, is interesting, and I'm excited to explore that with you. So just give us some background on what Ownify does, and then how investors and your traditional single family home buyer get connected into this system.
Yeah. So let me start maybe with just the problem statement itself, right? This notion that first time buyers are struggling, and I think we all kind of know this anecdotally. And you hear it in your circle of friends. And I wanted to dive into just, for a couple of minutes on why that is and how we can potentially solve for that, right? And so one big reason, obviously, is home prices themselves, right? Home prices keep going up. We've seen a little bit of a slowdown in the last 18, 24 months as interest rates went up. But if you look at the median home price relative to the median income is now somewhere around 7x, right? Which is the highest it's been in since the 1940s. So you have this kind of increasing problem, or the underlying problem of home prices keep increasing. And fundamentally, that's because we're short housing in the US, right? We're short somewhere between 4 to 6 million units, depending on what economist you follow and how you define the numbers. But so there's a supply-demand imbalance. More people want homes than we have homes. It keeps driving up prices. Then you have mortgage rates, right, which were artificially low for the last number of years, right, until about 2 years ago now. So the rates in the 2s and 3s, are gone, and we probably won't see them for a while, right? Long run, the average rate for the 30-year fixed is somewhere around 5.5%, right? And that's roughly where rates are going to go back to. They're in the maybe 7s and coming down into the 6s now, but they'll come down a little bit more, but they're not going to go back to 3 or 2.5, right, which you had. So you have that problem. You have the average first-time buyer today often has a college degree, right? And the student debt that college graduates graduate with is 60% of their income. Yeah. Right? So you have a great job. You make $100,000 out of college, which is fantastic, right? And not everyone gets there. But you have $60,000 worth of debt that got you there. So you have to pay that down. So house prices, mortgage rates, student debt. You also have a tax policy that for the last couple of years, right, ever since the changes in the tax code in 2017, you no longer deduct your mortgage interest from your taxes if you're a first-time buyer, because by and large, at that income and property value, you're taking the standard deduction. So you're not getting the support that we used to get from the IRS. And then lastly, you're competing against cash buyers, right? Depending on the market, you have investors, you have PE firms, you have Wall Street coming in. Right. And so if you're a first-time buyer who struggled to come up with a down payment, maybe needs a down payment assistance program, with an FHA mortgage, you're getting outbid time and time again. And this is what we saw in the data, right? Yeah. And in our launch market, the win rate for a first-time buyer with an FHA mortgage is like 15%. Which means
that sounds high even to me, really.
Okay, so you look at in your business, right? You're representing a first-time buyer, and you get this frustration. They make an offer, they make another offer, and 1 out of 7 is your win rate. That's pretty poor.
Yeah.
So that's the fundamental problem, right? And what we see then is the average age is now of the first-time buyer is 36, right? You go back a number of years, it was 33 and 29. And so, people just keep getting pushed out of the market. So what we did with Ownify,
Frank, one important thing, though, I just want to interrupt you for 1 sec, because I think, if we're talking about first-time home buyers, we're on an investing show, I think people don't realize that a lot of times that first investment property that people get comes from a HELOC on their first residence. So if you can't get the first residence, you can't ever get a HELOC. So this is even more important to figure out how can you get into a vehicle that can create equity for then future investments. So keep
Correct.
going. I just want to point that out.
Yeah, no, that's a great point, especially from the investor's perspective, right? Which is, how do you even get started in the first place? So what we did with Ownify, seeing this problem, researching it, looking into it, talking to a lot of realtors, thousands of first-time buyers, ultimately what we built is an equity-based path to ownership, which is probably the best way to describe it, which is rather than taking out debt and using a mortgage, we said, what if you could buy your home, your first home, brick by brick, right? So the question we ask is, why do you have to buy 100% of the home that you live in? Why couldn't you buy a small fraction to start with and then buy more over time? And once you have enough equity, you can go out and use that equity as a down payment, get the traditional mortgage, and buy the home the traditional way, right? So really, Ownify is designed as an on-ramp for first-time home buyers. And the main benefit that we provide to the first-time buyer is really the reduction in the down payment. So the ability to start with 2% down and have the ability to pick a home, single-family homes. These are starter homes that we're focused on. So generally 250,000 to 750,000, with the sweet spot being in the 3 and 4s.
Yeah.
And the benefit to the first-time buyer, or ONI as we call them, is you can get started with 2% down. You have a 5-year program where you make a fixed monthly payment, and that fixed monthly payment builds equity. So you're buying equity in the home, and at the same time, you're paying rent on the equity you haven't bought. And notice that this is equity, not debt, right? So there's no interest payment involved. There's no obligation to ever pay off the full balance of a mortgage. It really is the structure where we say we take each home and we turn it into 10,000 bricks. And each brick is effectively a share in a limited liability company that owns title to the home. And so over time, the customer buys equity by virtue of buying those shares. We call them bricks, right?
Yeah.
And the more bricks you stack into your own portfolio, the fewer bricks you have to rent. And as you build equity, then eventually you can use that as a down payment. And so on the flip side of that equation is obviously the question, well, how do you fund the purchase of the home in the first place? You need to bring investors into the equation to buy and hold the bricks that the customer hasn't bought, right?
Right.
So really what this is a partnership, an investment partnership around single family homes where 2% or 200 of the bricks are bought by the ONI, and they build up to 1,000 bricks over 5 years. And at the same time, 9,800 bricks are owned by investors, and those investors sell down to 9,000 over 5 years, right? And at the end of 5 years, the golden path is that at that point, the customer has built enough equity to buy the home with a mortgage and buy out the investors. Because it is structured as equity, one of the things we're doing is valuing each home every month, and therefore resetting the value of a brick every month, right? So if you think about this as, let's say we bought a $400,000 home, on day one, each brick is worth $40, right?
Yeah.
400,000 divided by 10,000. And a month in, that value may have gone up by $1,000, right? So now all of a sudden a brick is worth $40 and a cent, right? And so on and so forth. And over time, values go up, they might go down. But each transaction, every time a customer, the ONI buys a brick or an investor buys a brick, it's transacted at the then current market value. So it really becomes a marketplace for the trading, the buying and selling of liquid bricks in the home, right? And that enables the customer to build equity over time. It also enables the investor to own and hold equity, earn returns on that, right? And eventually, if we have enough, once we have enough volume on the platform, we can create liquidity, right? A secondary sale on that brick as well.
So I guess that owner's payments could go up if there's substantial appreciation, but so does the complete value of the house. So if they're moving forward, should be a win-win at the end of that 5-year cycle, correct?
There is, however, we fix the payment for the 5 years.
Oh, okay.
So as home prices go up and the value of a brick goes up, that fixed payment that the Oni makes buys slightly fewer bricks.
Oh, okay. Right. The opposite of the way I was thinking. Right.
Correct. So one of the things that in our consumer research that's very important to first-time buyers is to have certainty around the payment, right? So we set the payment over a 5-year horizon. But what we then say is, well, the value of the home changes, right? It could go down, it could go up. If it goes down, your fixed payment actually buys slightly more bricks, which is good. If the value goes up, your fixed payment buys slightly fewer bricks. And if you think about it, it actually means that the customer is dollar cost averaging the purchase of the home, right? And because we're doing this over a 5-year horizon, those valuation fluctuations kind of work themselves out. And in the vast majority of cases, you end up with roughly 10%. Maybe not exactly, but close enough.
Yeah, that makes complete sense. That's exactly why I didn't start a company like that, because I just had it backwards in my head. But the fixed payment is so important. I mean, I think as a first-time home buyer, even anybody who's taking out any type of money to buy a property, investor, home buyer, if you know what the fixed payment is and where the scale of it is, how long, when you can transition that ownership, you feel much better about kind of taking on the project. That's why adjustable rate mortgages are tough, especially if they're going to transition sooner rather than later. People think it's never going to get adjusted. And then when it does, they don't like it because they want the security. So yeah, that makes sense. Hey, it's Jonathan. This is just a brief interlude to talk to you about Deal Machine. Listen, I've used Deal Machine and I was crushing it with my Concerned Citizen postcard on Deal Machine. You can look that video up on my YouTube and find out how I did it. It works. Deal Machine works. I've had David Lecko, the CEO, on the podcast. So if you want a free trial of Deal Machine, the elite Driving for Dollars app, and I'm telling you, it works if you use it correctly, you can go to my link at bit.ly/Zen Deal Machine. Now, bit.ly is bit.ly/Zen Deal Machine. It's free and you'll be up and running in 2 minutes, and then you can figure out if you want to keep it. Let's get back to the show. So where do is this multiple investors investing in one property, or they're investing in a bigger syndication that then puts the fractional ownership on the other side of those first-time home buyers? Where's the connection?
No, and the answer is yes, we do both.
Yeah.
And so it depends on what kind of investor you are. If you're an accredited investor, the way to invest in homes with Ownify is into the Ownify Home Fund, which is a Reg D fund for accredited investors. And that fund invests across all homes. And therefore, you kind of build in diversification from day one.
So that model is more of like an index fund of homes in general, a cross section with a very smart return that you understand. But you're not saying like, oh, I have one in Kansas or I have one, in Missouri. It's a fixed, grouping of all of them.
And they're all in Raleigh, Durham. That's what the fund is funding, and that's where we're growing, right? And then we're adding markets in California, we're adding markets in Colorado. So we're looking at these as individual real estate markets and funds that really invest into those individual real estate markets. And the reason for that is that a lot of investors, have told us that I like the idea of supporting first-time buyers. I want to make sure that we continue to supporting ownership, right, rather than more rental homes.
Yeah.
And therefore, I want to do this in my, I want to do it in Raleigh or in Durham or in Chapel Hill, which is where I live, and I know that market. And so there's a benefit to being local, right, through the fund structure. The other way, and this is new, and we're still working through this, so I want to give that caveat. The other way investors can come into the transaction is through an exemption with the SEC that we're working on called the Reg A exemption. And the Reg A exemption is focused on allowing any investor, not just accredited investors, to invest. And it therefore removes the minimum
Right.
And what we're doing there is, if you think back to the bricks, we're allowing individual investors to buy bricks in specific homes. And the minimum there is 10 bricks. So again, for a $400,000 home, that could be as little as $400. And the reason we do that is that it allows the ownie and their community to co-invest in homes.
Yeah, that's just what I started thinking
back to the start of the conversation, right? Let's say you have relatives who don't want to give you a gift, but they're happy to support you by investing in bricks in your home, right? So I love you, but I don't like you enough to give you a gift, right?
Yeah,
so
you're okay, but I don't want to hand you the check, but I'd like to make some little bit of money on my money and also help you.
Yeah, and honestly, what we've heard from investors a lot of times is, I like the fact that there is an organization in the middle that structures all of this. It's an SEC qualified security, right? There's paperwork, there's an account, there's a wallet that I have online. I can look at it in the app, the Ownify app, right? So that feels very different than I wrote a check to my nephew.
Yeah.
Right? So part of the intent behind the Reg A filing here and the issuance of bricks directly to investors is the ability for you to say, I want to invest in Frank's house, but I don't want to invest in Pete's house, right? For whatever reason. Or I want to invest in this property because I know the property. Maybe I don't know the ownie. And what we can do with that is activate what we call the circle of trust capital. So those are family, friends, the community, church, right? Where you have folks in the local community who say, I want to support this specific intersection of the home and the ownie, right? For whatever reason, versus I want to invest in a fund that kind of spreads capital across all of these structures, right? And earns a return that way.
Yeah.
So we're enabling both, right? The fund and then eventually the Reg A direct into the individual home.
The Reg A is really interesting to me just because I had these two friends in law school who both of their parents said, do you want us to buy you a home or do you want us to give you a wedding? And they both chose the wedding and they both realized they never should have chose the wedding. But I could see as wedding gifts come in, people going in, to help the ownie as part of this. And it's like, wait, now, you're really stockpiling and people are invested. But like you said, they're not giving you a straight out gift. They're investing in something that can also give them a return. So those investors, if the property goes up and you said they get to that golden moment after 5 years where they can get a traditional mortgage, those ones who invested, whether it be Reg A or the other way, they're going to make more money if it went up 100,000 over those 5 years.
Yeah. And so let me double click on this. This is a really interesting thing. The thesis we had when we started was that this structure, if we do it right, can generate higher returns to investors than either investing in a rental home directly or writing a mortgage, right? Because you can invest in mortgage REITs, or theoretically you could write your own mortgage if you wanted to. And so what we found over 2023, the first full year of operation, when we look at the portfolio, we saw an unlevered operating return between appreciation and rental income of 11.3%. So a little over 11 relative to 8.2, something like that, industry average for SFR, for single family rental. And so when you double click on that, so why is that? One reason is that the rental yield that we can charge for the properties, or the bricks in the properties that the ownie hasn't bought, is top quartile, right, relative to market. And the reason for that is that, one, we pick very attractive properties. So we generally look at nicer homes, or certainly not fixer-uppers. So this is very far from the rehab kind of strategy. These are nice homes. And the optionality of building equity creates value in the product that allows us to charge for that through the rental income. So one, we get higher rental yield. Two, this was really interesting. As part of the thesis, and we're seeing it now, is the maintenance and repair costs are significantly lower, somewhere around 60% lower than what you would expect. And the reason for that is that we have co-owners rather than tenants, right? We have people who live in the home, they own a fraction, and they end up taking care, making repairs. We had someone replace the floors, paint the ceilings. The light bulb goes out, they don't call you, they just fix it, right? So there's more of an ownership mentality and a behavior that way. The third reason then is we don't have vacancy up front, right? We don't buy a home until we have the ownie signed up for the 5-year agreement, right? So there's no lease up period. And then we have a 5-year lease, right? And so far we've seen obviously no vacancy on any of the properties. And we've seen, because of the credit underwriting we do, 100% on-time payment, right? Zero delinquent payments and any of that type of behavior. So from a pure kind of underwriting perspective, we're creating very attractive customers and very attractive assets, and they appreciate better and they perform better from a cash flow perspective than if you were to just buy a home and rent it to someone. Yeah. And that was core to this thesis, right? To say we're going through a fair amount of structuring work and, the underlying math and keeping the ledger is complex. But the value that creates is ultimately expressed through this ownership mentality, becomes, higher yield and higher capital appreciation for the investor.
Yeah. So logistically, you said that you guys don't buy the house until you have an ONI ready, but how are they finding the house? Are they looking at houses that, you have in some, like under contract, or like where like, are they still able to search regularly? And then do they say, I want to buy this? Are there investors for this? How does that process work? Because that's where I feel
not to sound too corny, but there's a magical person in the middle called the real estate agent.
Yeah.
So the way we've built the company is there's really three constituencies, right? And if you're a realtor listening to this, come to Ownify and check that out. There's a realtor portal we've built.
Yeah.
So the process for the customer is you come and get qualified through Ownify. That's credit and income underwriting, right? We qualify you for a home budget, and then we say, congratulations, Jonathan. Here's your budget. It's $400,000. At that point, we pair you with a realtor. If you don't have a realtor, if you have your own realtor, we ask that you bring that person in, and then we qualify or accredit the realtor. So we have an accreditation program that we've built to make sure that the real estate agents, the realtors we work with, understand how the product works, understand how the program works, and can accurately represent it. And so ultimately, the home search itself is conducted by the realtor in conjunction with the customer. And they come back, and the realtor can do it live on our portal. A customer can't do it. They have to use the realtor to do it, but they can submit an individual property. They say, here's this home I found. It's 123 Main Street in, Apex, North Carolina, and we value it. We do 3 different valuation approaches. We do an inspection, and then we approve or decline it, right? And generally, there's a buy box and guidelines we have up front back to, we don't do fixer-uppers. We don't do, rural properties. We have a buy box that, ensures that ultimately there is value appreciation here, both for the investor and for the ONI.
Yeah.
And that's the kind of, the home selection and underwriting process, if you will.
Yeah. So like just from a timeline basis, I would see it could be trouble for someone. I mean, this isn't something where you can really bid into multiple bids, because there's things on your end that you'd have to do to qualify. Where I am, there's 20, 30 offers on houses all the time. And then it can be a drawback for a seller to say, oh, well, you have to do 2-3 steps. But there's also opportunities out there, the houses that don't sell in the first week, and then there's nobody else there. That's a perfect option for them. Is that kind of a better sweet spot for those buyers?
No, actually, I think it's the opposite. So what we've built is it's a purely online process. It's very quick. So we can qualify a property, within a couple of minutes.
Oh, okay.
And then what we do for the customer and the realtors, we say we are making a cash offer, right? If there are contingencies, here's what they are based on the initial review.
Right.
But an all cash offer with a tight and aggressive closing timeline usually beats.
Right. Makes sense.
An FHA with a second inspection, maybe, a 30-year fixed with a, long financing period. So part of the benefit to the ONI and to the realtor, quite frankly, is, we're aggressive professional home buyers. And this is what Ben, my partner, who's bought 5,000 homes in his career, we've built a process that supports the buyer with the intent of winning the deal.
Yeah, that makes sense. I mean, I'm glad that the listeners can go on the journey with me, because I think it's going one way, and then I'm like, oh, wait, no, you describe it, it's going the other way. And that is the perfect solution for what you want to do. And it's also kind of the antithesis to going up against the big hedge funds that are paying cash for properties. There's no real buyer for that. So for sellers who are interested in not just getting the highest price, but delivering to a first-time home buyer, a lot of sellers want to deliver to someone who can make it their first-time home buyer. I think a lot of people forget about that, especially if you can be competitive and you have cash and you have a quick close and the process is easy and the realtor in the middle understands how to explain it. Then you're giving them a quality product. And I do agree with you. I think that is a huge upgrade and then does make it compelling to go because sure, cash it's not always what everybody wants, but they want an easier process. So if they're working again with professional home buyers who are then the conduit for a first-time home buyer, I can see that pitch being very compelling from agent to agent as part of the process.
Yeah, we've seen really good reception from the agent community in our launch market, right? Where we've had local brokerages come in, we've done the training at their lunch sessions, at their sales meetings, right? And then we've had individual agents come in and accredit themselves. So we have about 250 agents in the Raleigh-Durham area today who are actively submitting leads or who are getting leads from us to say, someone comes in directly, either through a Google search or they saw us somewhere, they get qualified and they don't have an agent, right? We partner them with an agent.
Yeah. No, it's interesting. And I think, and where are you finding your traditional investors, the ones who are investing in what the product is now, that typical kind of syndication where they're going to be in the modified index fund just for the town, which I did want to mention this because I didn't say it at the time. I think that's really smart that right now you're just focusing on Raleigh and then you'll expand to other towns. So like you said, locals can invest in their area and not have to think, well, okay, I'm investing in a fund that has properties all across the country. Like, I don't know what is happening in Illinois. I'm not comfortable with that. I think that makes it a really acceptable model and a tighter syndication model. So where are you finding those investors from right now?
Yeah, a lot of it is word of mouth, right? So initially it was friends and family. It's now kind of into the next circle of folks who, especially in the local market, right, in the Research Triangle, where folks have learned about this and are coming in and they have the affinity to the market and understand the local market. Obviously, a lot of it actually through the realtor community, right? Realtors are often also investors and interested in real estate. They understand it, right? They like the model. If I don't have to buy the whole thing, I can invest in a fraction, right? We have a number of investors who actually are motivated by the social impact, right? This notion of I want to invest in homeownership because I know it's a long-term societal good, right? It helps communities, it helps the tax base, it creates, more stable families and communities. And so there's a benefit there that folks see. And, we've aligned our mission with those kind of economic mobility and homeownership sustainable goals. And because of that, we've also had investors come in with their DAFs, their donor advised funds, to make investments through a 501c3 into the Ownify Home Fund, right? So that's another vehicle or another path, right, where folks have used kind of their donation dollars, if you will, to support home ownership. And at the same time, generate market rate returns and real estate tax advantages in that investment. There's different groups of investors and different motivations and reasons behind this, right?
Yeah, but I think what I'm thinking is a lot of things in real estate can be diversified within one asset. And this type of investment into this is what would be considered a passive investment into a fund. But then you have that impact angle that you said, and great, I don't have to know that maybe I just funded Bob and Sally's house, but you're getting part of the overview and maybe you learn that stuff over time. I think they collaborate really well because we talk a lot about passive investment and that most people interpret it wrong. Multifamily investing isn't passive. Landlording isn't passive. This type of investment is very passive and safe for the investor, but you get a little bit extra with this to know that you're having more impact in an era when, unless you're hiding your head in the sand, like housing's not affordable, like we talked about. So yeah, I really like it. And I think that does give that extra push for the investor.
And you go back to kind of my personal journey here, right? A big part of what motivated me was, I spent a long time building a successful software business that was basically helping big banks make more money, right? And that's great, but it's also at some point, not the mission that you want to be proudest of in your life. So I said, here's a problem that actually needs solving, right? where people are struggling, and I have the background and wherewithal and kind of the knowledge of the system to figure out how to make that work. And that's why we're focused on this, right? So what I'm excited about is that we found a way to help first-time buyers. We found a way to increase return to investors and at the same time solve this problem, right, that is so prevalent today. So that kind of double, triple bottom line is what I'm excited about with Ownify.
Yeah. No, I remember the first time I really caught wind of just fractional ownership in general was probably with Picasso, but that didn't have that extra, hey, you're going to contribute. It's vacation homes. I mean, it's a cool product. You have 8 people sharing a vacation home. But again, like for the investors, they're investing into that property. These investors who are investing into the fund. But the Reg A thing is really interesting. So if the listener, if you missed it, go back and listen to the part where Frank and I were talking about the potential of the Regulation A, because I just really see that as very like collaborative and participatory and community related, for having your local friends and family be able to donate, a very small amount of bricks to your potential home ownership, but then also being able to benefit it, from it later, instead of, getting you another toaster for your wedding that you got 4 cool toasters already.
Right.
So what markets are you looking at now as you expand outside of Raleigh?
So Raleigh, Durham, Cary, Chapel Hill, that's live today. We're adding Charlotte, so the other than Wilmington, and eventually rest of North Carolina, right? But it's really focused on the metro areas.
Yeah.
The next market we're evaluating and are close to is Denver, right? Suburbs of Denver in particular. We're working on the Central Valley cities in California, so Stockton, Modesto, Bakersfield.
What's quote affordable California? I mean,
interesting. In those markets, you do have homes still selling for $350, $400, $425, right? So
sure.
Single family homes, especially new construction, right, works there. And we've also looked at individual investors, have had conversations with individual investors who've come in and said, I really like this market, and I care about Dallas and suburbs of Dallas, and I want to fund homes there. So we're a little bit flexible around that investor conversation as well, to say if we can find anchor investors, right, larger investors,
right,
then we're open to looking at other markets. Really what we're doing as a platform, right, as Ownify, is building a platform here that enables homeownership through fractionalization, right? And there's a bunch of different directions we can go with that. We can follow the capital, we can follow the consumer demand, we can bring the two together. We can also help landlords transition some of their tenants into owners, right? And this is another piece that I'm excited about, to say, if you have, 50, 100, 200 properties out there, you will have some number of people who are probably looking to buy, right? And they're your tenants and you know them. And this is a product and a path, right, and a structure that can actually help you transition existing renters into becoming owners, right? And along the way, you can generate higher return for yourself.
Yeah.
As an investor owner, right? And put your tenants who've been supporting you, quite frankly, financially, onto the path to ownership.
Yeah. When in the beginning of the episode, when we were talking, I was thinking this is a much more customized, advanced rent to own possibility, because that is what a lot of investors want. You end up with 20 properties and you're over 60 and you don't want to manage them, and you love the tenants. They're paying, under because you love them so much. But yeah, what if both sides could be incentivized to turn that into ownership over 5 years? That's another great option that I think people would want. It's again, for me, like looking at real estate overall, I'm always looking for what can be a win-win. And what you're describing is there's a lot of win-wins here, where all parties that are involved in the equation can have a win. And I think that's important. Whereas there's a lot of parts of real estate that are, you're in wholesaling, you want to grab the house, make a profit, maybe not pay attention as much to the seller. But a lot of these things are all tied together with everybody who's invested in the project getting a plus out of it.
That's exactly right. Yep.
Yeah, awesome. Frank, is the best place for people to get more information about it? I think it's ownify.com, and that's OWNIFY.com, correct?
That's exactly right. Ownify, we turn renters into owners.
Yeah. Yeah. And so, I like you call them the future buyers, they're ownies. And if you go across social, just look up Ownify. I think your Instagram is at Ownify Home.
That's right. Ownify Homes.
Yeah. Awesome. Well, Frank, it was a pleasure. This is really interesting as someone who's interested in tech and where real estate and tech meets. I like to talk about it, and I think people don't understand the impact that you can have by creating new solutions to things that maybe nobody thought of before. So I wish you a lot of success, and I'm sure you and I will continue the conversation on this because it's very interesting to me.
Well, thank you, Jonathan. I appreciate the time, and this was great.
All right. That was Frank Rohde. I was going with Ownify. Yeah, I could just collaborate them together. That was Frank Rohde. He's the CEO and founder of Ownify. You can look them up at ownify.com. I'm Jonathan Green. We'll see you next episode. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.